Extreme weather and extreme returns. Some investors are finding profits in perils. This is Inside ETFs, and we're talking about catastrophe bonds. Hurricanes, wildfires and floods. Extreme weather is hitting harder and more often. So who's willing to take on the financial risk? Surprisingly, more investors than ever. Catastrophe bonds let investors bet on where climate disasters will strike and profit when they don't. And demand keeps rising. But once-in-a-generation events are happening increasingly frequently. Everyone wants an all-weather portfolio, but are you ready for the storm? Let's ask Ethan Powell, Principal and CIO of Brookmont Capital Management. So Ethan, as natural disasters become more frequent, insurers have been paying out more than $100 billion in catastrophe losses every year this decade. So why are investors so eager to take on this bill?
Well, a number of reasons, one of which is just the risk-adjusted return of the asset class is phenomenal. You're talking about a low double-digit floating rate yield that has a correlation of less than 0.01% to other risk asset classes. And as you can imagine, there's no credit risk, right? So when periods of economic stress hit, a lot of the other credit-related fixed income alternatives tend to spike in correlation. Here, you don't have that, and you're being appropriately compensated for the risk. In fact, if you look at other comparable corporate rated double B debt, our fund generally trades at a 200 to 300 basis point premium relative to that risk that you're assuming. That's very comparable.
Well, one issue is that investors' capital can get trapped after a disaster owing to settlement delays. Should uncertainty about payouts be a major factor in investors' mind, and is there more risk than expected?
Well, no, because the annualized impairment rate is generally between 2 and 3%, which compares favorably to high yield bond default rates of roughly 3.5%. And increasingly, the mechanisms by which these payouts occur are much more binary and maybe less what's called indemnification, which is associated with the actual claims that are being submitted related to a disaster. A good example is the recent Jamaican hurricane. There were really only two incidents this past year that resulted in impairment. One was the LA wildfires, which were less than 50 basis points of the market, and the other was the Jamaican hurricane that happened last month. And that bond actually was what's called a parametric bond. So really, it just looked at barometric pressure, wind speeds, other measurable aspects of a storm, and pays out immediately. So you know exactly whether or not you're going to have to pay off immediately after the event. And what's great about that for the issuer, in this case Jamaica, is the finance minister was able to deploy those resources for a quick recovery for the island nation.
Well, you mentioned Jamaica there, and in the first half of 2024, a record $12.6 billion of cat bonds were issued by Mexico, Jamaica and Puerto Rico. Should investors zero in on specific regions of peril?
Well, some investors and asset managers do. We do not. Our perspective is if you look at a hyper diversified portfolio of catastrophic bonds, the chances that you'll be significantly impaired decrease dramatically, right? We've got a Japanese earthquake bond and a Chilean earthquake bond or an LA fire bond. And as you can imagine, they have effectively nothing to do with one another, right? Unlike corporate credit, which may have a contagion effect, here we're completely isolated from one issuer to the next.
Well, incumbents like Munich Re warn that investors flooding into reinsurance could destabilise the centuries-old markets. After a major loss, private capital could bolt. So isn't there a high risk of volatility ahead?
No, absolutely not. I mean, we look at the insurance gap as the biggest driver of the growth in catastrophic bonds. And the fact that as you pointed out, a very I'll say stagnant capital market in the insurance and reinsurance business really needs to evolve quite quickly in order to meet that need, which is why we're seeing a lot of innovation in the catastrophic bond marketplace and a lot of appetite from investors to invest in it.
So finally, Ethan, asset managers are pushing back against the EU's attempt to restrict retail investors' access to bet on natural disasters. They're arguing that regulators are overstating the risks. So is growth in this sector limited?
No, and ironically, I think there's 15 billion in UCITS funds in the EU related to catastrophic bonds. So there's definitely an appetite from more of a retail investor base. And just like any other sort of innovative capital market, it's going to require regulators to fully understand the risks and make sure that investors appropriately are, disclose those risks and understand the risks as well.
That was Ethan Powell from Brookmont Capital Management. Don't forget, you can watch more videos on Reuters.com.